T. Rowe Price is one of the most popular dividend stocks I see here on YouTube, and it's for a good reason. T. Rowe Price, an asset management company, has $1.4 trillion AUM, or assets under management, and has grown its dividend consecutively for 36 years, which makes it a dividend aristocrat. This means even during the dot-com bubble, the 2007 to 2008 financial crisis, and the 2022 bear market, the stock grew its dividend. In addition, T. Rowe has a high dividend yield, currently well above 4%, which makes it a good payer as well. For all these reasons, the stock has been super popular amongst dividend investors for quite a long time. However, I have a reason to believe that there is a stock similar to T. Rowe that could be just as good, if not better, depending on your portfolio's needs, which I will discuss in today's video. To clarify, I think that T. Rowe is an absolutely fantastic stock in any portfolio and that there isn't much wrong with it, but this stock that I'm going to talk about in this video might just be a little bit better. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. The other stock that I'm talking about is, of course, BlackRock, ticker BLK, which is the world's largest asset management company with $9.4 trillion in AUM. BlackRock also dishes out the iShares family of ETFs, which you may already be familiar with. So let's compare these two financial giants and talk about which one is better for you. So firstly, we have to talk about dividends if we are to talk about these two stocks. If you are focused on just dividends, whether because you think dividends are the most important thing in your portfolio, or whether it's because you are getting close to retirement age and need extra cash flow, T. Rowe might be your better option. T. Rowe has declared a $1.22 dividend for every quarter this year so far, and it pays a much higher yield at 4.32% when compared to BlackRock's 2.8%. In addition, T. Rowe Price looks like it can and will keep growing its dividend, ensuring its 36-year track record of paying and growing dividends stays intact. This is because in the first half of this year it increased cash to $2.2 billion, up $500 million from the beginning of this year, and had $2 billion in free cash flow. Its current payout ratio is just over 70%, which is high, but it can still be sustainable and with room to grow, especially if T. Rowe keeps growing its cash on hand and crucially if the market is to stabilize. Now, let's talk about BlackRock's dividends. BlackRock, which trades at over $700, declared a $5 dividend for every quarter this year and has grown this dividend for the past 14 years, basically every year since the financial crisis. The 5-year CAGR of this dividend is pretty good at around 13%, but it doesn't really matter because T. Rowe is basically the exact same. As I mentioned previously, the yield is around 2.8% and it has a payout ratio of 56%, which is lower than T. Rowe, meaning it has good room to grow. However, even though the payout ratio for BlackRock is significantly lower, it must be argued that T. Rowe Price has the more attractive dividend due to higher payments and longer history and a similar growth rate, which makes it a better pickup for investors who are mainly focused on a higher dividend pay. BlackRock also trades at a P/E ratio of about 20, while T. Rowe trades at about 16. In addition, T. Rowe is down nearly 50% from all-time highs, while BlackRock is down only about half of that, meaning T. Rowe's price is also very attractive for value investors. The reason the stock dropped so much is due to the bear market, which saw a decrease in T. Rowe's AUM because assets were both worth less than during their peak and less people were putting money into the market, which resulted in less fees for T. Rowe. Once the bull market is back though, both of these stocks should see a significant rise in valuation as the value of their assets will be up again. However, when it comes down to sheer performance over the long term, BlackRock has fared better than T. Rowe by a considerable amount. Going back really any amount of years, BlackRock seems to have T. Rowe beat in annualized returns for investors. Over the past decade, BlackRock has returned an average of 9.5%, beating the market, while T. Rowe has only managed 4.3%. Over 2 decades, the gap stayed the same, with BlackRock averaging 14% returns while T. Rowe only managed 9%. Here's a chart on screen comparing the two stocks as well as SPY. Some of the lines have dividends included and some don't, but as you can see, BlackRock seems to easily outpace both SPY and T. Rowe. Although past performance does not indicate future, it is still a good metric to look at for investors and shows that the people leading BlackRock know what they're doing. BlackRock also has, in my opinion, good future growth prospects. They are a leader in the fastest growing segment of the entire market, a segment that is popular amongst almost all investors, ETFs. Because of their iShares family of ETFs, BlackRock has managed to add even more assets under their name. BlackRock's equity ETFs added $70 billion in net inflows, which is up tremendously from last year, in which they added only about $48 billion. The bullish market this year also seems to be helping BlackRock tremendously, as in the second quarter this year, $86 billion were added from institutional investors into actively managed portfolios, up from just $5 billion last year. This means amongst both retail traders as well as institutional investors, BlackRock is seeing major growth year over year, and although this bullish market is also in theory helping T. Rowe, BlackRock seems to be poised to reap even more benefits. This is because, relatively speaking, T. Rowe was late to the game of actively managed ETFs, only releasing them within the last few years, meaning their market share, when compared to BlackRock, is super slim. Really, I believe both of these asset managers are great additions to your portfolio, but I truly believe BlackRock is the better choice for the long term. They have a reliable dividend that is only growing from here, and it should continue delivering market beating returns. However, for investors who need more dividend income for whatever reason, T. Rowe Price is a great stock to add as it yields over 4%, and I don't think anyone should second guess the stock if they're already invested in it. Let me know if you agree in the comments or whether you have a different opinion. I'd love to hear all responses. Thank you and goodbye.